Welcome back to our video on inflation. Inflation is the decline of purchasing power of a given currency over time. A quantitative estimate of the rate at which the decline in purchasing power occurs can be reflected in the increase of an average price level of a basket of selected goods and services in an economy over some period of time. The rise in the general level of prices, often expressed as a percentage, means that a unit of currency effectively buys less than it did in prior periods. Inflation can be classified into three types: demand pull, cost push, and built-in inflation. Demand pull inflation. Demand pull inflation occurs when an increase in the supply of money and credit stimulates overall demand for goods and services in an economy to increase more rapidly than the economy's production capacity. This increases demand and leads to price rises. With more money available to individuals, positive consumer sentiment leads to higher spending, and this increased demand pulls prices higher. It creates a demand-supply gap with higher demand and less flexible supply, which results in higher cost push inflation. Cost push inflation is a result of the increase in prices working through the production process inputs. When additions to the supply of money and credit are channeled into a commodity or other asset markets, and especially when this is accompanied by a negative economic shock to the supply of key commodities, costs for all kinds of intermediate goods rise. These developments lead to higher costs for the finished product or service and work their way into rising consumer price inflation. Built-in inflation is related to adaptive expectations, the idea that people expect current inflation rates to continue in the future. As the price of goods and services rises, workers and others come to expect that they will continue to rise in the future at a similar rate and demand more costs or wages to maintain their standard of living. Their increased wages result in higher cost of goods and services, and this wage price spiral continues as one factor induces the other and vice versa. So now we will understand the various causes of inflation. So the first cause is rising wages. If trades unions can present a united front, then they can bargain for higher wages. Rising wages are a key cause of cost push inflation because wages are the most significant cost for many firms. The next cause is import prices. If there is a devaluation, then import prices will become more expensive, leading to an increase in inflation. A devaluation/depreciation means the pound is worth less. Therefore we have to pay more to buy the same imported goods. The third cause of inflation is declining productivity. If firms become less productive and allow costs to rise, this invariably leads to higher prices. The fourth and the last cause of inflation is printing of more money. If the central bank prints more money, you would expect to see a rise in inflation. This is because the money supply plays an important role in determining prices. If there is more money chasing the same amount of goods, then prices will rise. Hyperinflation is usually caused by an extreme increase in the money supply.